Good to be on the show, Jim. Thank you.
All right, Sanjay, I listened to the whole call, and I know that there was a big perception, maybe misperception, that because your revenues are going up, your margins should be going up, and therefore your margins were very disappointing in terms of a projection. Is that true, or did people and the analysts just gang up on you because they were so darn wrong, recommending your stock between 47 and 51?
Well, Jim, our revenue, as you pointed out, guidance for FQ1 is actually higher. The midpoint is higher than what we achieved in our FQ4. Our margin guidance is lower. That is because there is in DRAM still some excess supply. But what is important to note is that the end market demand trends are back to normal now. Customer inventories are back to normal. The industry has some excess supply that is impacting the pricing. That's affecting our FQ1 guidance here. But it's important to note that the demand growth is now higher than the supply growth. The inventory in the industry is coming down rapidly. So basically the stage is set for improving fundamentals in the industry. As I look at 2020, yes, in the first calendar quarter of 2020, there may be some seasonality, but long-term health of the industry, I'm optimistic about industry fundamentals in 2020.
Okay, Sanjay, that's important because long-term 2020 is like tomorrow. I felt that you did not speak enough about demand growth in the call, whether it be for smartphone, graphics, cloud demand, and those would have changed the dynamic had you addressed them. Again, I think the stock went to 51. I think the stock went to 45. And the confusion I had where analysts were expecting that this next quarter was going to be huge instead of 2020 being huge.
You know, long-term demand vectors, as you pointed out, are absolutely strong in our industry. Just look at the trends in cloud computing. You know, AI applications are driving more need for memory and storage, and new CPU platforms are being introduced in the market that have more channels that require more memory and storage, more DRAM and flash. Look at smartphones, 5G. This is going to drive long-term growth in the market. Average capacities of content in your smartphone for DRAM and flash absolutely continues to increase at a rapid clip. And we are very pleased, whether you look at IoT, autonomous, cloud, smartphones, and market drivers are all pointing to increasing content. In fact, this year in smartphones, flash content is increasing by about 50% on an average, and DRAM content is increasing by about 25% on an average. So demand trends are solid in our industry. We are just in a period of excess supply. And again, the industry has done a good job. Certainly Micron has done a good job in terms of controlling its supply growth so that now the demand growth is greater than supply growth, and that bodes well for the long-term fundamentals of the industry. In fact, in DRAM, in some parts of our business, with leading-edge nodes, we are actually seeing some supply shortages for our business. So I'm enthusiastic about the opportunities ahead for Micron.
Again, I thought you didn't emphasize that enough on the call, and I think people kind of took a misdirection. Okay, so you bought 80 million shares. There is still a huge amount of firepower in your buyback. That's only $2.7 billion. You have a lot of cash. Stock at 45, 46. Go to your board, go to your treasurer, go to your CFO and say, let's go back in, because I understand that you did not buy stock when it went to the high 40s, low 50s. This is your sweet spot, and you're going to put money to work after this interview.
In our fiscal year 2019, we actually bought back shares at about average of 40, $2.7 billion given back to the shareholders through share repurchase program. And we remain committed to dedicating at least 50% of our free cash flow on an ongoing basis towards share purchases.